Hey, what's up, everybody? Welcome to Ask Me Anything, the infinite banking, money, financial weekly show where we answer all your questions around IBC, becoming your own banker, real estate investing, private money lending, and most any topics around financial control. And we'll even get into a little jujitsu and sports on the show every now and then. So college football is in full swing. NFL kicks off tomorrow night. A lot of good games going on. So good luck to whoever your teams are this season. Let me play a quick little video for everybody, and we'll be right back to do some introductions. In the meantime, please get your questions in the comment section over on the side. We'll answer all those shortly. We'll be right back in about 14 seconds. All right, cool. Welcome to the BYOB Money Multiplier. Ask Me Anything, where we answer all your questions. We have what we call our BYOB Money Mentors on the call to answer those questions. Get your questions in over in the comment section. Of course, you can watch this show every single Wednesday, 4:30 Eastern on YouTube, at the Chris Noggle, at Private Money Club, or on Facebook at Chris Noggle. And it's also streamed to the Money Multiplier channel. And what else on YouTube, on Facebook? Maybe those ones. And then sometimes it's streaming to Instagram as well. But best way to watch is on YouTube at the Chris Noggle or at Private Money Club. So with that being said, a quick around the horn who's who of this Brady bunch of money mentors. Start over to my right left with Mr. Brian Fouts. What's up, Brian?
Hey everybody, Brian Fouts here up in the Pacific Northwest. Kids are back in school. And now they're all sick and home right now. So it's been a fun week. They're all, hey, go back to school. And then I had to go pick up my daughter who threw up at school. My other son is sick. It's just been an interesting. Now my wife's sick. So the joys of going back to school. So, but luckily, I'm very grateful that I'm able to actually help people out and do these kind of calls and hop on people no matter where I'm at. So with that, I'll hand it over to, let's see, who's Carson?
There you go.
There we go. Popped up to the top. What's up, guys? Carson Herline here, coming from Southern California. Love being here with everyone every week. I have a podcast called I'm the host of the podcast Generational Gains, where we talk about all things money in terms of my relationship with my father and I. We talk about real estate investing, IBC, money management, from someone who's been in the business for a long time and someone who's starting their career. And so we have a fun community of other like-minded entrepreneurs who are young, ambitious, and want to get out of the rat race and learn how money works. And that's what we're all here to talk about. And so I'd love for you guys to go check that out or check me out on Instagram, where we talk about these things more in depth and I share more of my story. That all being said, we're here to talk about IBC, and I'm pumped about it. So let's go down to the next person in line here, or I guess up. We'll go to Craig.
Yeah, we're moving around. Chris has got himself in the center there, so I pop up into the top corner here. But Craig Yenny, now I'm moving. Craig Yenny, south of Denver, Colorado, on the Front Range, and like everybody else, just excited to have you guys here. Ready to answer some questions about IBC, how to pay down debts, how to make more money with money, how to buy major purchases. So get your questions in and we'll get them answered. So I guess we're going to go up to Joe in the corner. We'll just keep going back up in the corner there.
I'm Joe. I'm from Buffalo, New York with Chris. And I live and breathe IBC and HELOCs and getting easy cash moving. And that's why I'm here. So let's move back over. How about the other corner? I'll pick Linus.
Hey, it's Linus Nolt here from Hopkinsville, Kentucky. I live and breathe applications and working with the underwriters at the insurance companies in order to qualify and get these types of banking policies approved for you. And so that's really what my daily workings are of my brain. But I work with all these guys, helping you with the infinite banking concept. Happy to be here, answer any questions I can help with. Let me hand it over to, see who else hasn't. Jason, I see your face. Go ahead.
Thank you, Linus. Thank you all. Another it's Wonderful Wednesday. Another Wednesday we're here together. AMA, having fun, moving all around to make Joe laugh. Steven's having some fun down here in the city, beautiful Orlando. Excited to be back with the group. Excited to be here and answer your questions today. Founding Fathers tomorrow, 3 p.m., talking about all things infinite banking and just keeping it simple, having fun. Chris hasn't gone yet, but he looks very regal sitting in his studio. So, Chris, say hello.
Hello. Sorry, my daughter paid a surprise visit, and she's running around just terrorizing the entire office and the staff. So, yeah, that's why I'm coming on a little bit
Definitely
late.
priority.
Yeah. Oh, yeah. No worries. No worries.
V.
She's 4, and she's just raging.
Get a cameo. Get her in here.
All good. Just been doing lots of YouTube stuff. Been super pumped on some of the new footage we're putting out. Really excited about the new BYO Porsche channel as well. And it's here to talk infinite banking and privatized banking. I mean, I just sometimes I feel like I'm just not always the right person for the questions because I'm so deep into this that I can't even see my way out of the rabbit hole anymore, because I just think as soon as I kind of come up to the surface and I look around at what the average person is doing, I'm just like, is everybody stupid? And I don't mean it in a mean way, but it's just once you see the light and once you see how this works, it's so difficult to actually think that other people think this is dumb and their way is the right way when the banks are the only ones winning, and it's so easy to see. So honored to be on the journey and doing it and won't stop.
All right, cool. We got a few questions that have already come in, so we'll get hit on those. But before that, Jason, why do they call Orlando City beautiful?
I don't know. I looked it up one day, and beautiful place, I guess. I have no idea. It's been called that for a long time. Yeah, I looked it up. I didn't really get a good answer for you.
Legitimately a swamp in the middle of nowhere before Disney came in and built it. But okay, so here we go. So first pre-submitted question. A while back, Chris had Mark Podolsky, owner of the Land Geek, on podcast. I was wondering if you had any insight on his program. Thought it was legit since he was on your podcast.
So when I have people on my podcast, we don't vet the program to make sure that it's good, bad, or indifferent. But I do know he's got a really good name. We always will kind of look at what they're doing. He's been doing it a long time. So, I mean, I would certainly do your own due diligence, but I mean, he's been doing it a while, and I don't see any bad comments out there. I mean, between him and Jack Bosch, I mean, I think those are the two guys doing a really good job with that.
Yeah, absolutely. And if it's land flipping, we're actually putting together a land flipping program for private money club members. That's probably pretty cool coming down the next couple months. But yeah, I know that we've had Jacques Bausch on before, Mark, and these guys do a great job. It's an interesting strategy for real estate investing. It's actually one of the few things I've actually never done in real estate, and wouldn't mind learning a little bit more about myself. It's similar to wholesaling as far as a lot of marketing, a lot of negotiating, buying properties, right, which is a solid part of real estate. And then on the flip side of that, if you're looking about land development, maybe not how to do land development, but we have some really cool people in Private Money Club that do land development that you can build relationships with. So if you're not already a member, go over to privatemoneyclub.com, create a free profile, go on the forum and post, make connections and meet people on there. That's what it's all about. All right. Moving on. So Mark said, has anyone submitted their policies to Infinio to be digitized on the blockchain?
I did. I had Brandon upload all of mine on there. I mean, there was kind of no reason not to just have another digital footprint of all the policies and what they are. And then I let my wife know that I did it. So, she'll always be able to track them down, or anybody will.
Cool. Is that something anybody can do, or is that kind of a closed?
Yeah, it's totally free. It's just a service they provide for free. Kind of like, how we'll do calls with clients. Our money mentors will do calls. We don't charge for those calls. Same thing. There's really nothing to it. You just got to have your policy info in front of you. You upload it all, and done deal. Now it lives in the blockchain.
Cool. All right. Chris says the Seminoles look like to be in a lot of trouble. Yes, Chris. I would agree with that comment. Thank you for ruining my day. Let's see here. Damien said, so I just started my second policy. Awesome. Congratulations. Growing your banking system. What is the fastest way to get it to 25,000 so I can start lending?
Put 30,000 in.
A good question before starting the policy.
Yeah, or just continue funding it. Like if you're funding it monthly, just put the max in and get it there as quick as possible. I mean, there's really no fast way to wealth. I mean, it's just a build. That's how I did it. So I don't know any other way.
I would look at the illustration and see when it hits 25K as cash value. There you go.
Bingo.
The other way is a second policy to grow it faster.
Yeah.
Cool. And if you do want to schedule a call, it's I can put it in the chat box, but it's mentors.beyourownbanker.com. If anybody that understands infinite banking wants to do a strategy call about starting additional policies, we can kind of take a look at what you got going on. Does it make sense? Also on that link, if you're not familiar with infinite banking completely, there's a 90-minute video that you'll want to check out on there that's really powerful. That'll teach you the basics to give you enough information to ask good questions when you do get on that call with one of us money mentors. All right, Chris Smith used to be a police officer, so thank you for your service, my good friend. Looking for funding to get started in real estate investing, not using zone money or credit, maybe no money down.
First, that's always like, hey, Chris, I'll give you some advice. Just being a lender, and I know you're just asking a question, and we'll get to the question, but just so you know, that would never, ever, ever be something you'd want to post if you're looking for money. That you don't want to put any of your own money down, because that just means you got no skin in the game and you can just walk away, and then the lender's left holding the bag. So refrain from every bit of the verbiage you used in there, and then head over to privatemoneyclub.com, create a free profile, put a photo up, show if you're in law enforcement, definitely put a photo that you're in law enforcement. That gives you instant credibility. Lots of people will thank you for your service. And then never, ever, ever say you want to get started in real estate, not using any of your money, none of your credit, and no money down, because you will literally get blacklisted and nobody will ever lend you, because that's basically saying, I want zero risk, but I want the lender to take 100% of the risk. And if it doesn't work out, oh, well, I got a job, I'll just walk away. That's how I read it. Now, I know that's not what you meant, but I'm giving you some just criticism from a lender to a borrower. That's just really solid advice I could give you.
Yeah, yeah. Even if you don't want to use your own money, there's ways to present that in a way that attracts lenders, and you'll be able to get the money. But that is what Private Money Club is for people like yourself to find people that have money so you guys can connect and make these deals occur. What's up, Vivi?
I would also recommend to Chris, you take a look at subject to investing. So it's using existing financing to acquire properties. That's actually how I got my start in real estate. I didn't have money and all that kind of stuff, no money down. So I did subject to investing, started acquiring properties using the existing financing. I got down payments on the back end and created cash flow essentially out of thin air. I mean, it's creating notes essentially is what it's doing. Phenomenal strategy. It's more involved, and it's also very good after a recession or after a reset of the real estate market. It's a phenomenal concept. So I'm actually talking about it with my mastermind group because it's going to be something I'm going to be doing again here in the next couple of years. So
yeah, I love that you said it's good for maybe after a recession or a downturn in the market, because one of the things that worries us right now about sub 2 in this current market is I think we're going to see a lot of these deals go bad, and there's going to be a lot of negativity around it for a while as the market turns. So being prepared now for when it is a good time makes a lot of sense, though, right? Right. What are we eating? Pringles? Playing with Paw Patrol? Brum. Who is that? Is that Marshall? I see Marshall. You know you got kids when you know all the Paw Patrol figures, right?
Case is on the case.
All right, cool. Let's see. Robert says, hi, Chris and everyone. Love your content. Thank you, Robert. If you have 1 million gain from crypto, would you front load 1 million policy plus death benefits and then pull 90% out to put into real estate?
I mean, you could.
I mean, I would. It depends on your situation and what else you got going on and what that looks like. But yeah, is anyone want to expand on that?
Why wouldn't you?
Yeah. Lock in those gains. You know? Do you think there's going to be any volatility in crypto in the coming months?
Oh yeah. I love that, that Robert's saying, if you have $1 million gain, that means you sold. Good job. Good job. That's all I can say.
Yeah.
Now you can turn around and whatever money you put in your policy or use some of it to pay the taxes on that gain.
Yeah, that's what I was going to say is that if you have a gain in crypto, there's the tax implication. We're not CPAs. It's not tax advice. But one of the things that I've had the client doing recently is they had a big gain. They're saying, oh, my gosh, I got a big tax bill coming up. I got to set that money aside. I'm like, well, wait a second here. Lock it up through the policy cash value first, as what Linus is saying. Now you have that money in your hands instead of the IRS's hands. And it's going to be in your hands for the rest of your life. Then they pay the taxes and then just pay themselves back, and it completely changes the game. So definitely a consideration.
Sweet. All right. Scott says, would it be beneficial to borrow from a first lien HELOC to fund an IBC policy, Joe?
Well, I think it wouldn't be a bad idea because then you can make money twice. That's what I'm doing, and that's what I teach people to do. You do have to be in control of your money, and you have to, kind of don't overspend, and there are repercussions behind it. But for the most part, if you're doing it the right way, then obviously you can make money twice.
Key part, do it the right way. You got to be very careful when you're taking a loan to then take another loan.
But then if you're going to put it into an investment to capture more money to pay for the HELOC, now we're on the right track.
Cool. Yeah, Scott, definitely hop on a call, and we can walk through exactly what it would look like for you, kind of show you that and see if it makes sense.
What's up, Juan?
Let's see, we got a chaos crew in the house. Looks like Vivi and those two could cause some trouble, huh? Quick question. If you are to borrow instead of withdraw, do you have to create a repayment plan? I understand the process of you should pay yourself back, but what would happen if you do not repay?
Yeah, I can run with this one. We did in the recent 3-day, we just went through a kind of retirement strategy where we show taking withdrawals from the policy or taking a loan. Now, the thing is with the withdrawal, you're taking money out. You're not going to be able to put it back in. So it's not like a bank where you take it out and put it back in. So when you withdraw, you don't have a repayment. The only thing that you need to be careful of is if you withdraw too much and you go past your cost basis, some of that could be taxable. So let's say you put $100,000 in your policy and you take out $100,000, you're fine because that's your cost basis. As soon as you take out the next dollar, the rest of that is going to be taxable. So a lot of times what happens is you withdraw to cost basis and then you take loans. But all of those things need to be kind of orchestrated so that you don't blow up the policy, meaning you don't take so much out that you hurt the policy long term. So
you want to talk any about not paying the policy loan back and kind of why? I mean, like if you're the chaos crew, if you're in like looking at this as starting a new business, right? And you're going to do something that's going to take a long time to build. You're going to build it to keep all the interest in your family, to finance all your things you're going to buy in your life. Then when you ask that kind of question, I'd be concerned just thinking, okay, well, if you're willing to pay interest to banks now and other families now, why wouldn't you pay yourself back in some form or fashion? Whether you're paying yourself back in a structured way like Chris likes to do, or unstructured where you're just putting in sums of money when you have it, or at least a simple interest to keep it from eating the growth.
Yeah.
We want to teach you how to be an honest banker.
Yeah, in most cases, when you're using it for, like Jason said, you're using it to pay down debts or buy major purchases, those would be loans and repayments. But if you're in retirement, that's where most people start looking at the withdrawal as an option. So using it throughout your life most likely wouldn't do withdrawal. After you get to retirement, it certainly becomes a plausible way to move forward. All right.
What do we got next?
Hold on, sorry.
Damien had some other questions too that if you want to go back to his question about how he can get, 25,000 into the policy as soon as possible. And one of the questions he can go back, I don't know who Damien, if we get some more details, like who the policy's with, like what carrier, what is like the design, we could give you a little bit more guidance on that too. Because you can go back and ask the carrier or ask policy services, how much additional PUA you can put into the policy without necking it. And you can ask that question every month. And they'll give you a number so you know how much you can put in to keep filling it up until you need a bigger container, like a bigger warehouse. Getting there, Steven. There.
All right.
And so if it's 10,000, like so let's say you have 4,000 to the base and it's One America, like you'll be able to put an additional 34,000 ish in that year if it's year one, and then in year two it'll be a different calculation. You just have to ask all the time. Use your implementation specialist to do that as well. But you'll be able to kind of put more into the policy to get more efficient, to grow faster, to do all the things you're trying to do.
Yeah, I think the reason he was asking, now that's a little clearer, is he had almost mech'd his one policy, trying to get it, get more cash in it than that. So I think that was the reason. Yeah, you can always call the insurance company, or, if we set your policy up, you could give us a call and we can figure out where your mech limit is and get you to 25 the fastest way possible. Second of all, thank you for your service. And folks, did you see he's a merchant marine? So he's a badass.
Yeah, I guess I noticed that.
Don't cut him in line. Well, Gabe might just pick a fight just to see how Gabe's doing.
No, man, I'm not a fighter.
Yeah.
I'm a teacher.
There you go.
Different vibe. Can I piggyback on that? So because if you have an opportunity to do a lending deal, and just because you don't have $25,000 in your policy, maybe you have 20 or 15. If it's a good deal, you could always come up with the rest of the cash from your cash or from another savings account. I've done, bought some properties or even with my business here with my jiu-jitsu, I couldn't fund it completely with my policy. I used my own money, but just getting that habit of put the money first in the policy, use whatever loan available you have to go out and make you more money. You might have to, that over time, now I have a second policy. So now I can put more money into the system, but I just couldn't fund it all in the beginning. Right. So if there's good assets out there for you to buy, because that's where we make the money is on the purchase, if you come across a good deal. And now's the time it's hard to say no to good deals, right? Because they might be a little bit scarcer. It might be a good idea to do the deal anyway. So it's just something I look at it.
Awesome, Gabe. And Damien, so the question, if you want to write it down, or you can email me at, jason@themoneymultiplier.com, is just, you're asking policy services. Just, you're going to put your policy number. You're going to say, hey, in the month of such and such, in policy, put the policy number. How much additional PUA can I put in without meching the policy? And they'll give you an answer. They got to run all the calculations and stuff, and they'll give you an answer. Steven did it not that long ago and couldn't put anything additional in it, probably because he put a dump it into it, but that'll at least give you a standing of where you're at today. So, and congrats too, by the way. Policy 2.
All right. Stan said, I'm 54, had cancer in 2020. How hard would it be for me to do infinite banking?
Wouldn't be hard. you'd have to go insure someone else, possibly. We still could do banking. Might just have to do a policy on someone else.
Yeah, Stan, if you get with us, we can run kind of the details. Just let us know the details of the cancer, like what the treatment was, what kind it was, all that good stuff, and we will, and what the follow-up's been, and we will run it through preliminary underwriting to see if they potentially offer you a policy yourself, and if not, like Carson said, we can discuss, you owning the policy, just having it on somebody else's life, so that way you can still use it for infinite banking, even if you weren't to qualify yourself.
Yep.
We would ask the underwriting first, right? Like if you're cancer free now, and I just had someone get approved that had cancer and has been cancer free for a while. So depending on what type of cancer and the rest of the medical diagnosis, we could always find out for you if you're insurable first before looking at another body or another insurable interest.
Yep.
So another reason to be on a call.
Cool. Let's see. John Fisher said he's just gleaning knowledge, which is Joe's favorite thing to do as well. Obviously, glean the knowledge. Juan said, bring Brian, my man. We need to meet up. So a fellow duck hunter, maybe, or something of that nature. And I'll bring Brian to some fun
Let's wait to the duck hunting.
Not that he lives in Pacific Northwest.
He should bring the duck call to this. That'd be fun.
Right.
And Joe is quite the gleaner. Look at him. He's gleaning right now.
Brian did have to hop up. Brian's doing a webinar to Jesse Mills Group, who's a really cool real estate investor, part of Private Money Club, and does a lot of infinite banking himself. So Brian's over doing a webinar for that group right now, teaching a whole new group of real estate investors how to take back control of their money and solve their money problem through the infinite banking concept, which is really, really cool.
Hey, Steven, can I interject with an Instagram question?
Please.
All right. Karen D. Hardy said, can you fully fund a policy right away? I have commercial building that is fully paid off with $1.7 million equity in it, and that I am looking to take a loan out in order to get the equity out of the building. So it's interesting because we were just doing this today. We literally had a case that was kind of going back and forth, trying to figure out how to solve for that exact solution of putting all the money in at once. And we designed a single premium, and we don't do a lot of these. So I want to preface, this is not a normal part of what we do, but in rare circumstances, it can be amazing. But we did a single premium, money in one time, very similar to this, not, 1.7 million, but, still quite a bit, hundreds of thousands. And I don't know about all of you, but did you see that illustration? Did you guys see that?
Yeah.
That was pretty impressive. I hadn't seen a single premium that was that efficient. So yeah, that would be the answer. I mean, get on a call with us. We definitely could design something similar to that. Now, the only disadvantage to doing the single premium, and there's a couple other solutions that we could talk to you about, is that particular scenario, it's a mech right out of the hole. So when you design them that way with one dump in, it's going to be a mech, which means it's going to operate from a tax perspective a lot like your savings account. So whatever money you make in that year, you'll pay tax on that money. So it doesn't operate in a tax-free environment. But if you're just comparing apples for apples, like bank account to the policy, the policy was just insane. It was really, really impressive to see.
Yeah, and Chris, we could also take a look at taking that money as a dump in and whatever, minimize the premium. And then you could use dividends to pay for the premiums going years 2, 3, 4, 5, and on. Which,
well, here, Craig, not to do that, but we just did one just like that, and I happen to have it right here.
Yep.
Let's see. This one, it was a $2.6 million dump in. In the first year, the first full year dividend, like from year 1 to 2, is $60,889. So this particular person did that. I mean, these numbers are nutty. It's 90% cash on cash year 1, 110% cash on cash year 2. And they're funding it 2.6 million dump with 600,000 per year. And the first year they put in 600. So, first year they put in 2.6 million. So the second year they put in 600, and they're able to take 660,824 out. I mean, that's just awesome. Just awesome. I get to present that to a client Friday. Pretty excited about that one.
So the moral of the story is there's a lot of cool ways we can do it, and it just takes booking a call to figure it out.
I was just thinking, rethinking our thinking all the time, right? We're always bringing new strategies, new solutions, just based on what the person's individual, because it's always specially engineered. So,
Well, Jason, the bad side to that is now that we've got all these new tools, it's like Vivi, going into a playroom, that is just loaded with all new toys. It's just like you don't even know where to start. So I kind of sometimes feel bad for Craig because like now we got all these tools and the ability to mathematically solve so many different things. It's like, ooh, what about this? Ooh, what about that? Ooh, what about this? Let's try this. And yeah, it's pretty wild what we're doing and how we're really pushing the infinite banking space into places it just had never gone before because everybody just followed the same set parameters that were laid out in the book. And now we're pushing those parameters and experimenting on so many different levels and layering in lots of different financial products to make it even better for people that do have large lump sums like that. Whether they want it to be a taxable account or non-taxable, we can facilitate both.
Now, when setting one up as a taxable account, a modified endowment contract, am I correct in thinking the death benefit would still be income tax free?
Yes.
So that was news to me. That's awesome.
That's my understanding. I mean, I'm always
it just gets treated like a bank account or trying to think of other view, a money market or an investment account where every year that you have gains. So in that scenario, if that was a MEC, that one I just did, 60,000 in gains would be taxable that year, just like your bank account. Like, when the bank pays you the measly little interest that they pay you, you get a 1099 at the end of the year. And nobody complains. They're actually more excited that they actually made something on their bank account. So when you MEC the policy, it just becomes like that.
Yep. We got a good question that just came in. Steven, can you pull this one up?
Yeah, hey, I was trying to go down the list here. So do we hit this yet? Hold on, we already went over that. Sorry.
Did we go over that one?
This one?
I don't remember seeing that one.
I've heard VUL can act as a Roth alternative after maxing out Roth IRA and Roth 401k. Could VUL be a good idea?
We've tried everything else. Come learn what specially engineered whole life could do for your life.
All I would say is, I come from the industry where I sold tons of VULs, and I also probably was one of the only ones on here maybe that owned a VUL, and they're dog shit, man. Mine, no disrespect to VULs. I get it. Like, that's the pitch. That's how we sold them. We sold them as a Roth alternative. It was literally the wording that we used when we sold VULs. So it's a Roth alternative, no restriction. You can dump as much money you want in. It's going to grow tax-free. True, true, true. But the thing that hurts VULs is the internal structure and the way that they're made up. And the fee structure on the separate accounts, the mutual funds, is absurd. You'd be better off, if you wanted investments, just open a brokerage account and then take the difference you want guaranteed and put it into a whole life, or just put it all into a whole life instead of a VUL. It's the same idea. You can do the Roth alternative, but you're just not going to have market exposure. So when you want market exposure, take a loan from your policy, put it into the market, buy the stocks, take the gains from the stocks when you sell them or the dividends, and roll it back into the policy. And now you're doing the infinite banking concept. No need for that overpriced, overcharged VUL that more than likely will, in 10 years from now, be a really bad decision because of the internal structure of how the costs are calculated. Remember, in a VUL, every year you're older, the costs go up. So if your investments aren't going up in conjunction with the cost of insurance going up, you're working backwards. And all of them will work backwards just simply on how the separate account investments run.
Tell us how you really
Book
feel.
a call, and I'll give you the inside scoop on VULs. There was a lot of lawsuits in 2008 because of those suckers.
All right.
Hey, Stephen, can you throw Dallas Sullivan's question up there? I don't think we really covered, or not his question at least. He's saying, I was planning to chunk 5,000 in next year. Next year will be different. The extra chunk I can put in this year, just 1,700 extra. Or no, wasn't it? Maybe not that one. Somebody was asking why so low.
That question right there? No?
I think it might have been a different one because I remember seeing it say, why so low? I guess the easy answer really is that we design them for maximum efficiency. And so we're not building them for a lot of extra room unless that's maybe part of the strategy up front. So we're trying to, like I said, the maximum efficiency. I think I actually lost my train of thought there. We're not putting any extra drag on it, I guess is really what I'm trying to say. So if you want more room, look at maybe opening a new policy. And like Jason was saying earlier, you can check every single month to see if maybe you can put in more again. So that's what I got on that.
Like, it will change. My understanding is it will change, right? Like, it will change as you're adding your premiums in if you're paying monthly. So depends if you do a dump in too. Dump ins can kind of limit it because it's additional paid up additions. A dump in is paid up additions. So you're actually like, that's part of the equation when you're doing dump ins. So it just depends if you've done a dump in or not too, Dallas. So it was the same person, Linus. I opened my policy in April. I asked how much I can chunk extra for the year. The answer is 1,700. Why so low? Again, because instead of a modified endowment contract, we've given you a maximum efficient contract, and you don't have any more room, and that's why eventually you'll end up opening another warehouse, right? A bank on 3rd Street. So.
All right.
I like that logo.
Judy says husband is going to be 64. Are there benefits of moving his 401k money to an IBC policy?
No. I wouldn't cross streams. If you watch Ghostbusters, the 401k is qualified money, and it's got its own set of rules for qualified retirement accounts. The 59.5 rule, which really isn't the case because your husband's 64, so we can rule out that 10% early withdrawal penalty. Now, moving it to the IBC, so we're going to talk two different sides. You could, if you're referring to Judy, if you're referring to moving like a chunk, like the whole thing, like if it was $100,000 in the 401k and you want to move $100,000 to IBC, you're gonna pay tax on all $100,000. So we'd have to have a CPA, your CPA, calculate what that tax burden is, and then just run the math to see did it make sense to move it from a tax, that tax deferred account, pay the tax on all of it today, which arguably could be the lowest taxes where we're going to be in, and move it into a tax-free environment. We'd have to just run the math. Now, I think the better way to do that is because he's 64. You could set up the policy. You could do a dump into the policy for a specific amount, whatever it is. And then every year take withdrawals from the 401k and put the withdrawals into the policy every single year. So you're moving money from qualified to non-qualified, moving it from tax to a non-taxed account. So that's a great move. And you can then have your CPA calculate how much can we take from the 401k each year without bumping us into a higher tax bracket or putting us into any bad tax situation. And then that becomes your premium deposits into your policy. So you're slowly drawing down the 401k while you're getting to fund the IBC policy, and you're taking it tax to non-tax. So that's a good move doing it that way. There's two different ways. You just have to run the math on each.
That's exactly what I would do. It depends on what you want to invest in too. If you're a huge mutual fund guy, then it might make sense to keep it there. But if you're like, hey, I want to get into real estate or private lending, maybe it makes sense to run out through a policy too. So it also depends on what you're doing. Or if you have a big purchase like a car coming up, you can't do that through an IRA or a 401k.
Well, the other thing too, Carson, is the IBC policy gives the death benefit. So for Judy, that would for both, for the husband and for Judy, that'd be a really smart move because you create an instant legacy while just transitioning money from a retirement account to a non-retirement account. So there's so many benefits to doing it. You just got to make sure that you don't trigger unnecessary taxation because you bump into a higher tax bracket. That's all. I mean, if that were the case and he just wanted to do private lending with the 401k, I would suggest moving it to a self-directed IRA at Horizon Trust. Then you can just lend and do all the stuff within the confines of the qualified retirement space and the qualified money space without having to trigger taxes. So there's a lot of options. You really definitely should book a call.
So Chris, what came to my mind is that whole retirement conversation you had on Wealth Webinar where we talked about covered assets, volatility buffers. So part of all this for you, Judy, is going to depend on your goals. But if you want to take some of that 401k money and do what Chris was talking about, shuffle some of it over to the policy, as the premiums, or you could take a chunk of that, put it into a single premium immediate annuity and turn it into a guaranteed income stream. And if you don't need that income, that could feed the policy, or you just simply live off that income stream. So there's a lot of neat things you can do depending on how much guaranteed income you want to have versus maybe risky income. So lots of different options there.
I'm going to try to find that video that we did.
Yeah, for some reason I always have trouble finding that specific one. It's titled something that wouldn't make us look for volatility buffers.
Sean is the best at finding those. I don't know what the title is.
Welcome back from the beach, Shauna.
Find us a YouTube video.
It's good it's good to have you here to pretty up the place.
But if we can find that video for
I
YouTube,
think I found it. But I don't know for sure.
but that's
Just let me know which
excellent
one and I'll look.
Well, it's the one with the volatility buffer and the covered asset where you kind of drew out the different options. It was based on that white paper from One America.
I'll find it. I actually bet you I can find it.
Yeah, I think I found it. I just haven't watched it. That one I just put in there could be it. It's eliminate money risk, the ultimate guide to creating a bulletproof retirement strategy is the name of it. And they spelled my last name wrong. You should look at that one and send it over to Drew. You spelled it Nagule.
Naguli.
People really struggle with your name on calls too, Chris.
Chris Naguli.
I like that one. I'll start calling him that.
I like the closed captioning. It always says Chris Nogle. Chris Noggle. Anyways. All right. In first year policy with One America, I've taken loans. I've got about 3 more months of year one. Instead of paying loans back, my focus is max PUA, make loan repayments beginning second year. Thoughts on that?
I love it.
I'd say the only thing I would consider there, Elizabeth, is taking enough to cover the loan interest, just so that doesn't compound on you. I don't know what your longer term plans are, if you have a way to, take care of that throughout the year. But if you don't, I personally don't like to have loan interest compounding year over year. So I might take some of that money, put it into the loan interest, and then the rest of PUA.
Boom shakalaka. I love this comment from the Navy first, Merchant Marine second, Damien. I'm going to reward myself this year by flying to Japan and hanging with my kids. I am glad to be in this. I was not able to travel before we came across the Money Multiplier. So
nice.
Very, very, very cool.
Awesome.
Johannes says, is it feasible for a person with flat cash flow and $30,000 overhead to use whole life IBC with 80% of overhead as a monthly deposit and policy loan to cover overhead payments alongside a paycheck parking to accelerate cash value growth and uninterrupted compound interest? I know the policy loans would need to be about 10 to 50% less than deposit. I believe this should help them build in savings. And apparently that was a lot because they also added that. Anybody want to tackle that?
Are they asking, should I run my monthly expenses through a policy first? It's basically what they're asking, right?
That's what I understood.
Sounds like
Yeah, but this one's unique because it's a flat cash flow. So I'm just assuming that that's a flat expense. So like every month, it's the same amount. So if you put the money into the policy, use the money, put the money back into the policy, if you were able to do that, you just want to get upside down.
They said 7,000 is the overhead, 30,000 is the emergency fund.
Where's that?
A few comments below. So if they have
we talk
30,000
about it being surplus money, right? We talk about only changing one thing. Where does the surplus money go? So
yeah.
I know personally, I know you guys are more, I'm more risk adverse, baby. But when I see something like this, I think, hey, it's not a glorified checking account. It makes me a little bit nervous because business changes, right? That we're working with a doctor right now, and her business has changed a lot in the last couple months, where she's not having the same kind of income coming in. So what happens when that changes, when you're trying to run that through the policy? So
that's scary when docs have decrease in their incomes. We've seen that a couple of times now.
I was talking to a guy right before this call who spent 25 years being a financial advisor to docs, and his wife's a doc. And his whole goal is to help them start navigating the financial landscape and also teach the kids, because he saw a bunch of docs committing suicide because you think that they're high earners, but they're really getting taken advantage of a lot of places. Their incomes fluctuate, and they're going through the same things that we're going through. Yep. And they've delayed their life 15 years to be a doc, or 10 years, right? So it was a really, really interesting conversation.
The insurance companies are screwing doctors right now. Welcome to Obamacare. Back to Johannes's. I guess I'm trying to decipher the whole thing. So the 30,000 in emergency funds definitely should go into a policy. And then, if you were trying to fund the rest of it, and you got flat cash flow with an overhead of 7,000, as long as you could afford to, like if you dump the 30,000 into the policy and then you could afford to fund the policy's premium deposits out of that cash flow. But I think the question is not that. The question is, should I then use that to pay the expenses? And I'm not a fan. I know Nelson Nash in his book talked about doing that, but I'm not a fan of teaching IBC to use it to pay household expenses or even business expenses, because your money's not working for you when you do that. You're sort of just recirculating money. In the long run, would you make more money doing that? Yeah, but it's just it's an exercise in imagination that is, to me, a failed experiment, because your money has no way to regenerate you can't recapture it. It's not earning anything because it's just expenses. So really you're 100% relying on the compounding growth of the policy. Now, again, that would work, but it's just not exciting. Your growth would be, I guess the only word I could call it would be somewhat anemic. You wouldn't really see a ton of growth, because all the growth would be, depending on how you do this, and listen, there's ways to make this work, but your growth would be suppressed by the cost of funds, the loan interest being charged by the insurance company. So you're in the early years, you're sort of just balancing it out. And then later in life, yes, you'd pull ahead with the cash value, but it just wouldn't it would never be exciting like what we teach every single day. It would work, but it wouldn't be something I would teach, because I would just get so bored that I'd have to do something else with it. And there's risks with that. Your income can fluctuate, your expenses can fluctuate, so it's got a lot of holes in it.
If the 31 in is a dump and he put that into an investment, that would recapture the.
Like I said, there's ways to get creative with it and make it work. I just hate giving the thumbs up and be like, yeah, put money in the policy and then pay your expenses out of it. Because if anyone's saying that to me is just a commission play. Keep your money in the bank account and pay your expenses. Thank you.
And Chris, to your point, I think the point I would stress is you can make that work, but it typically takes you a few years of capitalizing before it really starts working. From day one, if you just put $1 in, you're pulling $1 out, put $1 in, $1, you're not really making much progress on that.
So it's not like anything that we ever create, model, or show in the webinars, the trainings, or the YouTube videos that like just blows people's socks off. I mean, in doing that scenario, it would work, but you'd.
When Nelson talks about in the book, he's talking about like years 10 and on. He's talking about when you've capitalized the system enough that all your money is actually running through the system. He's not talking immediate. Like we have the questions, like even Damien's question earlier, like there's only two ways to fund the policy. I know we come with a lot of creativity, but it's either you're putting a lot in and capitalizing a lot in the beginning, or you're doing it slowly over time. There's no magic here. You have to capitalize, put money into your system to make all of the other stuff we're talking about work. That's it.
I just want to add real quick that in my personal life, my emergency fund is pretty much like 100% what is in my policies right now is sitting in cash value. And then my immediate emergency fund is a credit card, for the couple of days that I need to take a loan or something and use that. But so my emergency fund is pretty much solely in my cash value right now.
And I'll second that. One of the things that, we've been talking about with Melissa, our bookkeeper, and Shauna a little bit is, we have a bunch of reserve accounts in the businesses. We have war chest funds and reserves, which are, they're just rainy, reserves are rainy day money. If something happens, war chest is, I don't know, down the line, if we want to buy out another insurance agency, buy an IBC shop that's just sick of doing it, we've got the war chest. So what we're talking about doing is shifting all the war chest funds from the bank accounts, which we have high interest savings, but those aren't going to last, and moving them into policies where I get a death benefit. So now if I'm gone, the company gets a big influx of tax-free money that could be used to replace me and find a bunch of people, pay a bunch of influencers to create videos on this like I do. But the whole purpose of doing it that way is not so much to use it for the infinite banking concept. So I'm kind of speaking outside of the realm of what we normally do. It would really just be a storage of wealth. So I'd put it into the policy because the internal rate of return, not something we talk about often, is still better than what I can get in a bank account. Plus, even though it's better than what I get in a bank account, so let's say my internal rate of return is in the early years 2 to 4%, in the later years closer to 6%. And again, this isn't using the infinite banking. This is just putting the money in and just letting it go in the policy. That's tax free. So that's really a 6% return. Tax free is more like making over 8% in my tax bracket. So that'd be the major play, is taking taxable dollars, future dollars, and turning them tax free, letting it be a storage of wealth that is protected from creditors, and also providing a death benefit, for like key man coverage. So if anything ever happened, I can be replaced. Or Stephen and Shauna can buy Larissa out with the death benefit.
I thought you were going to say buy a Porsche.
Oh, yeah, you can buy the Porsches from Larissa too, because she doesn't like them.
All right. Well, we're running out of time, but we got quite a few more questions, so we can do a quick little go. So Plan Your Greatness TV said, question, if I have 1 million to dump in, would you recommend to do it in the first year or break it up over 2, 3, 4, 5 years?
Oh gosh, I like that example I gave a second ago. Do it in the first year, as long as you have the means to continue to capitalize the banking system year over year that supports $1 million dump, which would be about $100,000 per year that you'd need to save to support $1 million dump. If you can't do that, then split it up over the 5 years or whatever.
Cool. Smart money culture. Fly. And so I talked to one of my buddies yesterday who had a hard money loan to buy $850,000 property. He's paying $10,000 a month after a year. He got financed at 6.125% for $656. I explained to him that he should get a first lien HELOC for $675 so that he has a little bit of a cushion, and that he should pay the entire $656.
I definitely would get the HELOC. I mean, even if he doesn't use the HELOC, I mean, let's just say everything falls apart in the market like we think it's going to. We enter a recession, everything goes on sale. Like, wouldn't it be nice to have $650,000 or $675,000 just sitting around, like waiting to buy an opportunity? I sure would take that.
Then I said, take his $14,774 a month income, put it into a HELOC, borrow back a couple of thousand for his bills, and then he should have his HELOC paid off in 44 months.
Joe, he did the math all for you. Joe was probably doing that math in his head. When you see his face, he's like, yeah, he's right. Wow.
Actually, to introduce you guys, this is Fly, who wants to bring us on television. So
that's awesome.
Cool question.
Well, you're speaking our language there, Fly. Definitely speaking Joe's language. Look at that smile on his face.
Casual
red too. He's happy when he starts turning red.
Casual Credit Gaming said, have any of you actually needed to use the fact that your first lien on a PMC deal when something went south? I feel like people talk about that assurance a lot as if the risk is mitigated, but I feel like that would be a lot of time and work to actually rely on, especially in a high foreclosure environment.
Yeah, absolutely correct. That would be a ton of work and energy and expense to foreclose on a property. There's no question. So it's like a last resort. But again, it's still better than buying a stock that you have nothing. If the stock goes down like NVIDIA, what are you going to do? You're going to call the lien, call NVIDIA up and be like, hey guys, like this wasn't supposed to go down. I'm going to foreclose, like, sell some of your equipment and pay me my money. Like, so it is always a fail safe. You never want to, and we'll never talk like, oh, wow, I hope they foreclose and I get to take the property, because it's a freaking nightmare to do. I've never had to do it, but I've heard of people that have. So the answer is I've not heard of anybody that's had to foreclose. I've heard of people, going through late pays and things and having to put pressure on with attorneys, but, so far, so good, at least as far as I'm concerned. They're actually, let me take that back. There is one that I know is going to have to foreclose, but even though it's a long it was a small amount of money that he lent, and it'll be a long process with him foreclosing, but the property's worth a significant amount. So he will be paid for the work. And you want to make sure if you're lending that's considered.
Yeah, cool. And then smart money. So Fly just followed up, said, I may have been off a little with the numbers, but this is going to save him $650,000 in interest. He thought it was too good to be true, but before I left his office, he asked me to walk him through it. He's going to send them to us.
Dude, there's nothing wrong with your math there. It's just he's so caught up in the way of thinking, and that's what we talked about on the webinar today, of thinking, oh, the rate's not that bad. Like, how can I pay that much? It's the volume of interest where you're losing. That's the thing. So you're absolutely right, Fly. Like, doing it this way, like, he would save that much because the simple interest is a way better calculation, and you can control it a lot more than the velocity or the volume of interest paid on an amortization loan, right, Joe? Am I saying that right?
Amortization is the devil's arithmetic.
No, it's the bank's arithmetic to make lots of money, and boy, do they ever.
Man, they are good at it. It still doesn't make sense.
Dude, it's brilliant.
Jason's going through it and he still doesn't make it.
Brilliant how they
like,
do it.
okay.
It's why Carson's dad said the ultimate in real estate is being the bank, because he understood that.
I have someone reading the 156-page contract, and that was their question today. Like, well, if the loans are 5 to 6%, and I have a car at 6.5%, I'm like, you got to go back and you got to look at the time value of money. You got to look at amortized loan versus simple interest. You got to start understanding that the uninterrupted compound is going to outperform that. But right away, we start thinking, when we're thinking in interest terms, that's just the grooming of what we've been taught to believe, right? So, like Chris said at the beginning, oh my goodness. Hi, Vivi.
Right there. Talk to them in the camera. That's
Vivi, over here. Over here.
Ah!
Look at all these people.
Okay. I'll see you in a little bit.
So-
Don't touch that. Hey, oh.
Perfect.
Oh,
Try to rip the camera off its mount.
oh shoot.
And Chris is gone.
Hey,
Just kidding.
Welcome back.
All
Hey,
right.
Stephen.
Yes.
Elizabeth was asking a follow-up question on that one about do I pay PUAs or do I put the money in the loan interest? So Elizabeth, what I was saying was that if, let's say that you had room in your PUAs and you had a loan interest charge at the end of your policy anniversary, I would pay the loan interest out of that money that you have available and then put the rest into PUAs. Carson said you could also just put all that into PUAs. So there's a couple different options. And some of it comes down to how aggressive you're going to be. Do you have money coming in later that you can cover some of that loan interest? So some of it just kind of depends. But what I was saying is just take some of your money that you're putting into the premium, cover your loan interest, and then put the rest into your PUAs. The reason I take that approach is it's kind of a conservative approach where if your loan interest compounds on you year over year over year, and for some reason you can't make a premium payment, you're putting your policy in danger. So that's just the approach I take.
Perfect.
All right.
What kind of profit can you make with treasuries given the stock market drops hypothetically by 20%?
Treasuries don't go up because the stock market drops, but when the stock market drops, it usually incentivizes or kicks in the Fed's monetary policy to drop interest rates or increase interest rates, depending on whether they're tightening or just easing. The whole idea with treasuries is when the Fed drops interest rates, like they're going to do in September, treasury bonds go up. Hence why treasuries in the last few days have been spiking up. It's because of anticipation or speculation of a drop in rates. So they're building it in already. So I've done the math on this several times, and I can't get exactly, how much interest rate they'd have to drop. But let's say the Fed dropped 2 or 3 points on interest rates, you'd probably see a 20 to 40% increase in treasuries, depending on the duration. But it has nothing to do with the stock market dropping, it has everything to do with interest rates going up or down.
All right. Let's see, you said, but with the HELOC, you would take out expenses, correct? Not the whole life?
Yep.
Are you saying that situation, how can they incorporate it into it? But,
Yeah, I think that's right.
Yep.
all right. So Johannes, that's exactly what I am asking. And then use other loans to invest in growth. And so I'm trying to get, this was from an earlier one too,
Yeah.
right?
Johannes, it wouldn't accelerate your cash value growth by using the cash value to pay for expenses. Because again, paying for an expense, your money's not making anything. It's just paying an expense. The money's just gone. So you're not really benefiting by doing that.
John, 67 years old, 30,000 in silver. Can he use some to ignite this concept?
Yeah, matter of fact, with silver, you could do what we do with cash value. You could get a line of credit. There are banks that will give you lines of credit on the silver deposits that you have, and then you could just use the line of credit to lend, or put it into a policy and then lend from the policy. Because when you got asset-backed lending like that, the rate usually can be pretty low. So you just have to search the banks that do that kind of lending, or sell the silver and do it that way.
Yeah, Velocity Banking Fly, right? Me and spouse have UL policies, NQV annuity, and a VUL, and no whole life policy. Can we use what we already have for anything cool or IBC-ish?
Yeah, it's just going to have lots of risk. So you got a non-qualified annuity, which is great, but it's a non-qualified variable annuity. I would certainly get that thing shifted into treasuries. Like in there, you got mutual funds in your separate account that you could move into treasuries or government. I think GOV is usually a big one that's available in all those variable annuity sub accounts. GOV is a government security fund. I would definitely preserve what you have in the variable annuity. The VUL and the UL, sure, you could use them for IBC, but it's never going to work like what we teach. But since you already got them, could you? Yeah, you can take loans from VULs and VULs, but the interest rate probably is higher on the loan interest. You'd have to, Pam, you just have to do a bunch of research on how much does it cost to borrow money from those policies. And you'd have to pay very close attention to that VUL, because as soon as the market flips and those sub accounts dip, boy, oh boy, it's going to be rough. It's going to be a rough road for VULs in the next year or two.
Cool. Last question. Anthony says, what would you say in regards to storage of wealth if someone argued the point of the dollar getting devalued and people saying to use Bitcoin as a storage of wealth instead?
I would just say, do you have a bunker in your backyard? Is it stocked with food? Do you know how to create gardens? Do you know hydroponics? Are you all set there? Cool. Yeah, then buy Bitcoin.
I like that new answer. That's good. That's good.
Listen, if that's what you're worried about, if that's your number one thing, you kind of lose sleep over. Like, I hope you built a bunker already, and I hope it's fully stocked with food, and got some ammo down there, and some guns and grenade launchers, and you might as well have some M60s and some what do they call those really cool guns, Steven? You know guns.
The Gatling gun.
Gatling guns, and yeah. I don't know.
A Gatling gun mounted to the front of your car in the vehicle in the bunker.
I love Bitcoin. Okay. I think Bitcoin's got a future, but I think Bitcoin is an incredibly unstable and volatile asset right now. So you just got to kind of buy it, close your eyes, and just, who knows, open them. I don't know when you're going to open your eyes. Probably when you come out of the bunker and realize that the world is still here.
Yeah. The dollar's getting devalued. I mean,
it's going to happen. They keep printing money, you're devaluing the dollar. But so is every other nation. So where are you going to go? I mean, Mars might work. I don't know. Elon hasn't figured that out yet. But I mean, there's not a nation out there that's not devaluing their dollar through fiat currency. Not one. And the United States is still the nicest house in a really shitty neighborhood, which is the rest of the countries.
Way to wrap it up. Another Ask Me Anything. Folks, we're crushing it here with these new stories from Chris Noggle.
Yeah, Anthony, just having some fun. It's one of those things where Bitcoin is
I like Bitcoin. I do.
It's just volatile, man. Volatile. And it seems to track the markets. I mean, it goes up when the markets go up, it goes down when the markets go down. I mean, the markets fell yesterday?
600 points. NASDAQ fell over 3%.
Guess what happened last night? Bitcoin fell like a rock.
Yeah. And I'm surprised the markets went down before Bitcoin, because if you recall, usually Bitcoin went down and the markets followed. So now they're so correlated. It's just like, it's hard to tell which one's going to go first. I think Bitcoin's a great thing, but would I put money in Bitcoin as a storage of wealth or a hedge against devaluing currency? No, I'd probably buy gold before I did that.
Well, NVIDIA had a little bounce back today, but still down almost 2%.
And just to wrap this up, like Anthony, for that question, when you ask, like, is like the 5 carriers we work with, right, the mutually owned dividend paying companies, they've been profitable every year their doors have been open. Like, think about that, like 148 years, 160 years, 107 years, 137 years, 100 years. So when you look at that, it's like like Chris just said, either you're building a bunker, you're waiting for the meteor to hit or the EMP to happen. Like, where would you want to put your money? Look where the banks are putting their money. Like, they're putting their money in whole life. That's where we put our money. That's why we're here. So.
All right.
And then you can buy your bunker with your policy.
Yeah.
Hey, there you go. With that being said, folks, that's a wrap for Ask Me Anything. Thanks, everybody. Your questions were awesome. And yes, you know, the U.S. has been devaluing the dollar since we came off the gold standard in 1971. Thanks, Chris. Absolutely correct. And it will not stop. It will continue. So giddy up and get ready. Nothing else is going to change.